All right. Good morning, everybody. It's CPI day. It's a biggie. We have the potential for a liquidity gap. Just to reiterate what a liquidity gap play looks like. 3 times a month, we get this opportunity at the 8:30 time frame. CPI, PPI, and non-farm payrolls. What we're looking for is this setup right here. I call it a liquidity gap, but I've seen others call it something else. Fair value gaps or something like that. I don't care, whatever. At 8:30, we're going to get news. Price, what we're looking for is a single directional push, up or down. I don't care. Doesn't matter. I'm on a 5-minute chart. You can find this on all time frames. And you can find similar versions at other points during the day. This is just ones where we know there's a likely anticipation of getting this. So we get the news, single directional push. It builds a bit of a base, and we work our way back to where price was at 8:30, and we get there around 11 o'clock usually. Here's another description where we went to the upside. Same thing, single directional push at 8:30. It didn't really build much of a base at the time, but it did base before the 9:30 RTH open, then down, and we got there near 11 o'clock, kind of fulfilled it just a little before, and then overshoot. Watch the clock, right? I say it all the time. Watch the clock. Here's another example, a CPI example, no less. Shot to the upside. It wasn't one single bar this time, but it was a single direction. So up, built a base, worked our way back down, got there near 11 o'clock. This is what we don't want to see. Here's a really great example of what we don't want. So if price is jumping in both directions, get big wicks all over the place, and then closes near where we opened, there just is no setup. Now, that's not saying we can't trade for the rest of the day or anything like that. It's just saying that this trade setup never materialized, and so we don't have the liquidity gap close play. So if we get wicks like this, then we're just done with it, right? That's it. Another example of the failure, another example of failure, and another example of failure. Now, I'll add something to this that we can't see in the pictures necessarily. We can get the single directional push, so the big move in one direction, and then still not get a gap close. So just because we do get the push doesn't mean we're going to get the gap close. Also, we can get the push and it might close on, say, the S&P, but not on the NASDAQ, or it might close on the NASDAQ, but not on the S&P. So it's just a liquidity gap. These gaps exist all over the place, and they're often associated with the rally base drop or a drop base rally, even rally base rally or drop base drop. If you haven't heard those concepts before, it's a bit of a liquidity play, kind of like a swing high 3-bar or swing low 3-bar, complex swing high. It's too early in the morning for getting into candle patterns. I don't nerd out that deep. Today's data is going to go to the heart of what the Fed has been working on for over a year now, fighting inflation. So this is a really big deal. The numbers are very likely going to impact the rest of the trading year. Just keep in mind what I continue to say. If everybody is jumping up and down, screaming about how we're going to get this really big move, we very likely won't get a really big move, right? Because they'll hedge it to the eyeballs. What makes price move? People being caught off sides, shock, surprise, and if you expect a really big move and hedge it to the hilt, well, then you're not chasing, you're not caught off sides, you're not surprised, and you're not going to see a big move. Now, that's not to say that there won't be some move and that it could get a little wicky on each side. And, we see the failed CPI examples. That's what hedging can provide, right? Big move in each direction, and then it settled right back down to where it started because nobody was caught off sides. Nobody was hedging. What I listen for on CPI day and days like this, when I'm going through the news, I listen for them to get overly confident and cocky when they start using phrases like, "Oh, we know the numbers are coming in hot. Well, we know they're going to be light." They don't know. They ask about 60 people, "Hey, what do you think the numbers are? You think they're going to come in hot?" And if the majority of the people say yes, then dun, da, 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 hey, we know they're going to come in hot. Psst, whatever. And when they're wrong, that's when we see the biggest moves because they thought they were going to be hot, but they weren't, or vice versa. Yeah, you like it. Hong Kong is up 1%, so we'll very likely dig around and check out the China ADRs and emerging market plays because at least, we'll have that to lean on while we're waiting on a very dull day that very likely won't offer very much. Japan is down just past a tenth, and everything else is kind of holding the line. The Russell is up 0.25%. I'll take it. It's not much, right? Behind that, the Nasdaq, then the Dow, and then the S&P. And they've just recently started creeping, right? Not much to it. So here's our biggest events for the day. Most of them at 8:30, but there is a 2 o'clock monthly U.S. federal budget. Looking at FX Street, I didn't bother to change the time frame because we're mainly just gauging the impact potential. We already know CPI is going to come in lit, but we do have the 30-year bond auction today. Now, I like the 10, but that doesn't mean I would dismiss the 30. The 30's got a lot of weight behind it, and it's worth keeping your eye on. Watch the clock, right? That'd be at 1 o'clock. We're going to get the 30-year. I know it says 18 here, but I didn't change that, right? So the 30-year auction at 1 o'clock, it's kind of a really big deal. The thing is, it can move markets completely outside of whatever we get for CPI today. And that's important to grasp, right? So we could be crazy bullish or crazy bearish because of CPI, have a fantastic morning, and then get these bond numbers and see everything change. Or it can pile in and give us more of what we already had. So going from bullish to even more bullish, or same thing, bearish, right? And just keep in mind, we do have the FOMC this week. So it's hard to see a lot of firms and institutions ponying up a position literally right in front of the Fed when we're all trying to get some clarity and some guidance on what they're going to do going forward. Right. So I think that is a good approach for any of us too. Probably don't want any swing positions. You really want to consider any positions you're already holding and maybe beta weigh them to see the impact and what that could look like. When you beta weigh your portfolio, you can measure your positions against a SPY move and then be able to answer questions like, if SPY moves 2%, how's that going to affect my position in, I don't know, uranium? Now, one thing that they like to do at Finance Juice is lay out a dollar, a 2-year, and an ES chart. Looks a little bit like that chart right there. Get some price in there, of course. And the idea behind this is, say we get that single directional push in one direction. Some traders like to actually trade that big move itself, not the retrace. If you're one of those kind of traders and you're sitting there with your finger on the trigger at 8:30 trying to go long or short when the numbers come out, using a chart setup similar to this would give you the DXY on one side and the 2-year yields on the other side. And if we get an S&P pop to the upside, then we'll expect the dollar to fall and the 2-year to fall in concert. And if it's a move to the downside, we'd expect those other two to move up. Okay, so it's not perfect, but it's more of a confirming signal. If you got the S&P ripping to the upside and these other two falling, you can kind of ask that question, should I go ahead and go long here? Now, they can change directions, whatever. It's no guarantee. It's just adding a little bit of perspective to the position that you're trying to take, right? And I showed an example of that last week. So if you wanted to go back and watch a morning briefing from last week, you can see where I showed a picture, and it was non-farm payrolls. So it was Friday's video, and it was a picture of the previous non-farm payrolls and that big move where the Dixie and the 2-year both had an exaggerated output with the ES moving in the other direction. It's like I continue to say, no matter what it is that you're trading, don't just look at that one chart. If you're trading Facebook, don't just look at Facebook. The ES, don't just look at the ES. Markets are connected. Price is your best indicator. So looking at price on multiple things is about the best you could do, right? There's your spot gamma levels if you want to catch a screenshot. And it looks like they just came out with a brand new video on their hero indicator. That's HIRO, not HERO. This thing is like the most advanced real-time option analysis that I've come across, focusing not just on the options flow, but on the stock flow. Because just real quick, if an institution comes in and wants to buy 5 million contracts of something, they'll take his trade, right? They'll cover his play because they're market makers and that's what they're supposed to do. But before they cover that option play, they'll cover their own butt by buying the stock. So this hero indicator is kind of twofold. One, it's going to look to see, was a massive amount of stock taken to cover the position before this big options trade was taken. It's kind of fantastic. There's so much more than that, but either way, they just came out with a new video. It's on YouTube. It's in the public, so you should be able to just search YouTube hero indicator and find that latest video. It's pretty fantastic, really. There are some thinkorswim indicators, by the way, that can look at options at volume, kind of lay it out like real volume, but you'd still have to pick your expiration and your strikes and all that. And there's just so many strikes and so many expirations that, you got to know where to point that thing. Whereas something like these are watching everything. So there's your events for today. 8:30, 10, 11, 1, and 2. We are above all of the levels And our put wall is actually integrated right into the middle between the volatility trigger and the 0 gamma. That's a lot of, I don't want to even use the word, but I don't have a better word to use. It's a lot of support down there. Just, don't lean on it like it's a handrail. Don't trust that thing. It's an old phrase that I used to hear when I was working offshore where everything rusts all the time. 6 crew members were all leaning against the handrail, and the big boss came out, yelling and screaming that we're all a bunch of idiots because we're leaning on this rusty handrail. And, roughnecks, oil field workers, we're big people, heavy. So it wasn't a friendly conversation, but don't trust handrails. Don't lean on them. That move to the downside, we can get there in a CPI push, PPI, non-farm payrolls, punches through levels. Analysis doesn't work when you've got that kind of flow coming in. But that put wall is where a lot of buyers are at, right? They'll monetize those puts. So even if they're just in there selling puts, right, which is kind of bullish neutral, that level is where we're expecting a lot of activity that would not be bearish in nature, right, when we get there. Being below 0 gamma kind of has its own implications, and the same thing with being above or below the volatility trigger. So I'm going to turn that thing off now. You already have the levels anyways from the screenshot. But with them out of the way, we can see the ADRs better. And we can see that 10-day moving average down there. Volume is better today than it was yesterday. We do have a market maker move, which I still say be careful this whole week, right? Because we're still doing contract changes. The March is still around, but we've got twice as much volume over the March series today. And the reason I said be careful with that market maker move is it's really big and it shouldn't be. And a market maker move is derived of these two numbers. It is only supposed to show up if the front one is bigger than the back one. And as you can clearly see, it's not, right? We're looking at a 14 over a 15. So there should not be a market maker move. On the other hand, it's CPI day, so there absolutely should be a market maker move. So we're kind of in a bad position here. I know they're hedging, you know they're hedging, but we can't gauge how much they're hedging because it's a contract week change and there's just muddy waters here, right? There's just nothing we can do about it. The average daily range, however, is still true because it's not based on optionality and it's not based on contract changes. It's looking at the continuous contract and it's asking, hey, over the last month, a market month, 20 days, what's price done on average? What does it normally do? Well, the answer is it goes to one of these two lines, which is how these two lines were formed. So what are we going to do today? We're going to go to at least one of these two lines. Funny thing is, we can go to both. It's not an either or situation. We can hit both of those easily. Less easy, but still doable. We can hit both yellow lines. We do have an MDP. It's a missed daily pivot. You can see the daily pivot right here, and you can see that we haven't hit it. That qualifies as a missed daily pivot. It won't matter until tomorrow, but yesterday we had a missed daily pivot, and that does matter today. If you want to know why or understand better why I even focus on pivot points and whether or not we've hit them, you can search for missed daily pivots. It's a strategy, but it's not mine. I don't want to teach it because it's not mine. I don't trade it, by the way. I just use it for analysis. A lot of things that others trade, I don't necessarily trade, but I do use it for analysis. And look at it this way. If it's good enough as a signal to go long or short, to put money on, to risk capital on, and it's good enough for me to use for analysis, right? So if somebody has a setup that they would use to go long, even without trading that setup, I can still use it as a bullish bias. I mean, that makes perfect sense to me. So we're working on this inside day breakout right now. The idea that we could come back inside of yesterday's level makes perfect sense. The thing is, we still have to try to focus on what are we going to do after this print comes in, right? So we're going to get the data, we're going to get the move, just kind of shake the tree a little bit, but then what? So if we're aiming for a gap close, then we're very likely going to come right back to where we are now, because that would be, closing the gap. But it's been a really good move, right? 80-point run in the last 4 days, and it has not been, necessarily a very easy trip. But we're out of the trash. We're out of that range that we've been stuck in for a long time. And bigger picture, that's what we want to stay above. So kind of the better line in the sand would be that 46.60. It basically the open of yesterday. And if we get back inside of that, then what I would recommend is just measure the whole range and deal with that in a 50% level and ADR half and all of our other pivot points at that point would come into play. Ten-day, 30-minute volume profile. We finally expanded beyond the range, broke that top. But we haven't really gone very far yet. And we do have that classic B shape. Again, we were starting to develop a little bit of a D, but now with the leg up, we're back to the B. If we continue to hold this new range, we could end up getting a capital B. We just don't have it yet. Notice the large, shallow area, by the way. So if we break this 46.78, 46.80 area, it's nice and shallow. We could drop through that relatively easy. And that would get us right back down into this lower zone, which is kind of what we want to stay out of, right? So there's that 46.60 level that I was talking about. Getting back below that would get us back into this chop. We are a little extended beyond the point of control, but I wouldn't stress on that too much yet. And with nothing really showing up here for structure, we could fall back down through that level pretty easy. We have a new VPOC underneath this from yesterday. $46.61.5, and I would rather have just a nice round number, but we're talking about where we're expecting unfinished business. So that's why we are so specific about where it is, right? That's where the greatest amount of trading happened yesterday. The strongest amount or the heaviest amount of trading activity happened at that location. Any unfinished business when we get back there is likely to yet again cause a reaction in price. So VPOC, the V standing for virgin untouched, we haven't been there. That's what we're looking to hit. I don't name this stuff, right? It's just named long before I ever came around. Dead cat bounce and virgin point of controls. And the zone is really clear for today. Very, very tight range. no real move through the kill zone or anything like that. And we're just hurry up and wait, right? Hurry up and wait for this CPI. We're still within our range comfortably. But I feel pretty good about the discussion from Friday and yesterday about how I would not expect to see price hold the range. You know, that's been the argument for a lot of CPIs is we just expect price to kind of hold the range. We would sell into strength, buy into weakness, wait on Wednesday. And in the last few FOMCs, that's not been the case. And so that was kind of my argument or my suggestion is, hey, don't try to do that because it's very likely going to be, you know, an outcome you don't like. And we've had that advance yesterday and this morning. And if we were trying to sell into strength, we would have been losing right now. We're still above the 10-day, but we're no better today than we were yesterday. Less than 1%, not overbought, got plenty of room. If you consider how far we've even traveled over the last 4 days, you know, sure, an 80-point run, that sounds pretty good. But we're not overbought, so it doesn't owe us a pullback at this point. I wouldn't focus on any least squared methods or mean reversion tactics at this point because we're just not owed any kind of pullback of that magnitude. Not on this short time frame. Looking at the 10-week, we're close to 4% away from the 10-week moving average. And while that is not, you know, too extreme, that's getting us into the edges of overbought. The thing about overbought and oversold that I don't like is even the words imply that it's gone too far. It's overbought. The reality is, though, it is where buying is at its greatest and that things can stay overbought and oversold for a long time. Kind of like the analogy of putting the gas pedal of your car to the floorboard. You can stomp that gas pedal and it's down as far as it can go, but that doesn't mean that your car is now going as fast as it can go. Your car is going to continue to accelerate, right? Until it finally tops out. So just because you've mashed it as far as it can go doesn't mean that you've now accelerated to your fastest speed. When you get something like an oscillator, RSI, for an example, pushing against 100 and they say, oh, look, it's overbought. Yeah, but it can stay there for a while and we can continue to press that overbought position. So we're a little extreme and it is a little overbought, but things can stay that way. It doesn't yet owe us a pullback, and we've been more extreme than that. Plenty of examples where we've been higher than where we are now and continued to go up. Okay, so yes, we're reaching that point where we expect a pause and or a pullback. But it doesn't owe us one yet. There's really no reason to dance through the equities, although we're going to go through the China ADRs real quick because we do have China up. It's just going to touch on the options for a moment. We'll use SPX or maybe even SPY. So when it comes to events, we generally see a market maker move like we have right here. The front end is greater than the next level out. Thus, we have a market maker move. And this shows us that hedging is going on. And so we know that there's some angst or some concern about our immediate market environment. Makes sense, right? They're a little worried and they want to hedge their position. So they go in and they trade in the front with options. And that trading is how volatility is measured. Now, on a stock chart, volatility is measured from candle close to candle close. But in the options, well, there is no candle. So how are we gauging volatility here? It's a little proprietary. They don't tell us every little piece of what it is that they're measuring, but each option strike has its own implied volatility value. We can see it here, right? Implied vol, we got the volatility per strike. So then when we look at the average volatility sitting on the side, this number is derived by adding up all of the out of the money options on the put side and all of them out of the money on the call side, and then they're averaged, and we get that number. Well, the volatility in here changes by the pace and the scope of the trading on that strike. So if they come in and they're trading the heck out of the 460, just hitting it really fast over and over and over, then that one strike is going to get a greater volatility than the strikes around it, which is why you might often find one single strike that's a little above or below its peers around it. But when heavy trading comes in, say for a hedge, and they're all getting traded at various speeds and size, then they all start to get bid up, and all of the volatility really starts to stack on the put side versus the call side, right? And then we get long tails, and it kind of gives us a little bit of a hint. With non-farm payrolls and PPI and FOMC all within, a 5-day period of each other, there's a massive concentration of volume in the front week, in this current week. So if you're looking to do some trades, just step out a little bit. You can see that we go from a 21 to an 18, but even just a week out, we're at 12. Right? Get out of this front week where this concentration is just so high, and you are immediately down from a 17, 18, and 21 into, 13s and 12s. Volatility costs money. So if you're looking for cheaper options, yes, they're more expensive because there's more theta in them. There's more time. Time is money, but they're cheaper because the volatility is less in them. Your cost to carry is less, everything else too, right? So just something to consider. I know we all like trading in the front end. They are the options that change value the fastest. But here's a handicap to that front end trading. Just a second, guys. It helps if I use the right keystroke. All right, sorry about that. So optionality is the point here. So give it a little room, get out of that front week, and your P&L volatility won't be so violent. The cost of the option won't be so bad. They're not going to lose value as fast, even if you're wrong. These options are going to get volatility crushed. I know that's something that we generally expect, for like earnings and things like that. And it's not just SPY, it's across the board. The entire marketplace is bid up for the FOMC, right? Everything, it just kind of bled into everything. So while other things, like say Caterpillar doesn't have, 5 options a week, that kind of thing, just skip this week, go out in time a little bit and get away from that front end. All right, so let's go take a look at the China ADRs. And the reason we're looking at those China ADRs this morning, or we were going to, is because Hong Kong was up. And with Hong Kong up, we would have expected KWEB to be up. KWEB is the internet ETF in China. So it's like it's a really broken, cheap, generic version of the NY Fang for us, for our markets, right? Just look at that and you see, oh, tech is up in China. And then, China in general is probably up, but it's not up enough. So we can go look, but Bitcoin is up. That would be Bitcoin proxies. I think that would probably benefit us better than looking at China ADRs, since KWEB isn't up at least 0.5%. So Riot is up this morning. Tried to perform a little bit of a gap close here, but it is still up. Pretty close to getting that gap filled. Riot had a deep drop yesterday and broke the 10-period moving average. So since we didn't hit the 20 and we kind of got a rebound that didn't even break through half of the candle, then the concern today is that we're just opening gapped up and that we just kind of roll over and continue to the downside. That's the concern. There's a gap that needs closed up here for sure, but this is still really negative. And there's a lot to retrace. That was a fantastic move. Mara is another one. Bitcoin proxies, nice gap up. It bounced on the 10s rather than cutting through the 10. It is above the half back this morning, but that's going to be kind of the trigger. And this is a nice setup, right? With since we're above that half back level on Riot, on Mara, breaking that would be a good signal to the downside. There is no gap close to worry about per se, depending on what kind of analyst you are. Now, I take it from candle close to candle open. So this gap is a gap that needs filled. Other analysts will only use the candle itself. And since we opened inside that candle, they'll say, well, there wasn't a gap. Hey, to each their own, right? Whatever. The thing is, be consistent in your analysis. So this is how I read gaps, and it's how I read it every time. This morning, we're also looking at a gap since we closed down here, and so far looking to open above 15. If I was looking for a short, breaking that 50% mark would be a good trigger for a short. Just be careful with this and with Riot. Bitcoin was up because of news. There was that discussion about the Bitcoin ETF passing legislation and all of that. So you really want to be mindful of the fact that it might not be done yet. There was also a lot of short coverings that gave it a lift. There was a lot of reasons that this just kept going, right? And if that bullish exuberance isn't done, then this is just a pullback before it continues to go to the upside, right? Kind of think about price making this big bull, coming back up, and now it's getting a pullback before it continues to go higher. Now, on a one-day trade, then sure, we'd still be looking for that downward, just playing the flows that we're going to get today. But in the bigger picture, this is a very large cup, and we're not there yet, right? We're not even to the top yet. If we do break 50% of yesterday, then the low of yesterday is going to be our first target. And then the ADR half of this bigger zone that I just measured out would be our target. The good thing about playing something like Bitcoin or these Bitcoin proxies is that you got plenty of names to look at. If you're trading coin, you can watch, Mara, Riot, Bitcoin itself. If you're trading Riot, you can watch coin and Mara. You got plenty of opportunities to look at other things rather than just that one thing that you're trading. Here we've got coin. This was a really nice recovery candle. And then yesterday, we never got outside of that candle. And we didn't get the gap closed either. Now this morning, we got a little bit of a gap up because of the Bitcoin proxies being up. Oh, I'm back on a weekly. Hold on. Hold on. There we go. It's a little better. So big candle Friday. We're still trapped inside of it today. We didn't get that gap, or yesterday. We didn't get the gap closed. And now this morning, we're getting a little bit of that pop up. So we're above the 50% mark. We're above the halfway point from yesterday. But there's still Friday's a big play, which is where we're hitting our head now, that 50% level, literally where we're tangled up. Any drive to the upside just seems to have a lot of resistance to the upside, right? And to the downside, 136 is a significant level. Right underneath that is the 10-period moving averages. So if we do get that half back break, that 139.5, first target is going to be 136. If we can cut that, then we'll go for 130, a little bit of an overshoot below that 20, below the 10-period moving average. This has been a fantastic run in coin. Now, I've gotten a few shorts out of this thing that have worked out so far, but I think I'm just, pressing fate at this point, trying to short this thing again. So far, they continue to work just because every little drawback really beats the options in my favor. But if we get a blow off top or one last hurrah to the upside, anybody shorting this thing is going to feel it. So careful with this. And it's not just this, it's all of these Bitcoin proxies, Riot, Mara, Hut, Hive. They're all going to whiplash at some point. If you're looking for more of a swing, then, get it underneath that 10. And for a swing, you could target the 10-week. Just, this is a picture of health and strength on this weekly chart. At the bare minimum, we'd want to cut through this 50% and then close outside of that recovery bar to the downside. If we were going to short this, shorting it from the highs is definitely better risk-wise. It's the least amount of risk. But shorting it from the highs is shorted without confirmation, right? So we've got the China ADRs. They're just not up enough for me, and they continue to drop. They're now down. They were at 50 earlier, then they were at 40. Now they're at 37. So we're losing those China ADRs this morning. Over the last 5 days, semiconductors have gained almost 5%, jets over 3.5%, banks 2.5 plus. And this morning we got bonds. All right, so we got gold, some precious metals, getting a little bit of lift out of these. We're cutting through that 10-week to the downside, and we're basically struggling with the 50-day. So these are up this morning. GLD has now got back above the RTH open of yesterday. That's not bad. Still a lot of work to do. So that's a pretty good gap that it filled. Think about R2G, right? Red to green. We closed down here. And right now this morning, we're way up here. So if we can get this inside day breakout, we can focus on getting back to the overhead 20-day moving average and the open of the previous day, just one pivot at a time. Get to 184.90 first. Then we'll focus on the close, 185.64. And then you can fight with the open if you want, but then you got the high of 186.78. Just one at a time, right? Level by level. 10 minutes before the news. So kind of brace yourselves for that. Everybody be careful, be safe. Have a good one. I'll see you all tomorrow.